The truth about Sony Corporation stock. Okay, this is one I'm really excited about, and the reason why is like Sony is such a phenomenal company. They're known so much for gaming, but their stock and their history and what they're doing isn't really as correlated to what you would like consider traditional gaming brands. If we pull up the ticker here on Binance and we just compare it to something like Activision, you're gonna see that these guys are in a similar sector, but they don't really perform the same as everyone else. Here we've got Sony on the candlestick chart, pretty basic, and Activision will come up here with this blue line, and you can see that like Sony hasn't really been up to par with what most people in this industry have been doing until you get to the short-term chart. And see, here's the cool, if you guys didn't see the videos on Activision and on EA, definitely go watch those, because stocks are about to like go to like, they're go down a bunch, just be like the best thing ever. But because they're about to go down a bunch, it's great to see that in the short term, these guys are pretty heavily correlated, because that's kind of what we're looking at here with Sony. The first thing you're gonna see when you get into this stock is that these guys are big, and they're really big. They're like at almost $75 billion. And they're highly correlated to the market, and I mean it shows. Their PE is pretty reasonable; it's like 10 right now. But just like we talked about with those other gaming and industry sector stocks, what we're really looking at here is a company that's making tons of money. They're earning tons of like billions of dollars, and I mean they literally have trillions of dollars in revenue. They're absolutely crushing it in all regards. But they're looking at a really, really interesting and difficult situation because of current times, because of current just like the virus, right? It's like the crash is coming, and it's like Sony's right here with it. And if that was all I had to say about the stock, like we would be done right now for the rest of the day. There'd be nothing else to talk about until I pulled up this chart on Thinkorswim, and here we have the chart of Sony on the monthly with the Bollinger Bands here, and that's when I freaking saw the setup that I could not believe. Now, a lot of you guys know this setup. It's like literally one of the coolest setups on the planet, and it's happened with these guys many a times before, which is what makes it even more powerful. And what it is really basic. You've got an interior Bollinger Band M setup. So here's sort of your Bollinger Bands, and you want to see it kind of bounce off the bottom there, bounce into the top here, bounce off the bottom here, bounce into the top here, and that's that. And that's your like ideal setup. Like in a perfect world, that's the setup you would see every single time. But the thing is with Sony, they're a little bit different, and it's okay, because on a monthly chart, I've seen this happen probably 2, 3, 4, 5, 6, 7, 8, 9 times. And what happens is you have an M, and it's just like a normal M, except instead of just having like your 2 Bollinger Bands, what I'm going to do is I'm going to draw the exterior bands in blue, and I'm going to draw sort of the middle band, which is a simple moving average in this kind of purple color. Okay, so you've got your exterior bands on the top, and the exterior ones on the top, like they have to be good. Okay, like this needs to be solid, and all of this applies to interior Bollinger Band W setups. Just flip everything on its head, and it's a W. But anyway, so here's the interesting thing though. So the middle line is the one that you can kind of like, usually you'll have the bottom one here, but the middle line can sometimes, on this second point right here in the middle of the M, this can act as the bottom for the M. And I've seen this happen a couple times, and it still works as a valid setup, even though it might not get all the way to the actual bottom Bollinger Band. It can still break out and have the exact same setup, where you basically take this right here, and depending on the stock, you can either do 1 time multiple of it, or you can do 2 times multiple of it for your price target. And it'll work really, really, really well. And that'll work as well here, where you have it where it hits not necessarily the actual Bollinger Band, the actual bottom band, but instead it hits the middle simple moving average inside of the Bollinger Band. And that's what we have here in Sony, and we have it twice, and that's what makes it a really, really interesting and valid setup, and something that looks really, really, really nice. So let's go and break that down. So before we talk about what the stock's doing right now, I want to first look at its past, because right here you have a really, really nice interior Bollinger Band M setup where it hits the top of the Bollinger Bands right here, it bounces off the middle Bollinger Band here, hits the top of the Bollinger Band here, and then what it does is pretty basic. You basically just take the height of this, and you can kind of add that to the bottom once, and then add that to the bottom twice. And if you do that, you get essentially exactly where the price bottomed out at. And it worked out really, 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 really well on this in M setup right here. And that was, it looks like 2006, 2007, 2008, this was 2009 and 2010. Like, these were recession years. These were some pretty hard years, and it just worked really, really, really well for Sony. And that's, I think, pretty much exactly what we see happening right now. It's a very, very similar setup. So before we get to that, one other thing I want to point out here, just so that you get better at trading stocks, is right here you have an inverted head and shoulders setup. And I'll kind of draw it in a lighter color so it stands out. But basically, you got your first shoulder right here, you got your second shoulder right here, you got your head right here, and this is a really, really nice setup. You take this height right here, you add that height to the top, and you got your target for that trade, and it basically hit that target within the span of like 4 or 5 months. This is a monthly chart, so maybe 6 months ever since it broke out here. And if you zoom in a little bit more, you can see, if I kind of erase these, there was a green candle right here, and then a red candle, and then a green candle, a green, red, green setup, and that was really the confirming thing for that inverted head and shoulder setup that allowed it to go up so much in only a couple of months. In like 3 months, it went from 22 to 32, and we're going to look at the options soon, but that is a pretty freaking sizable move, and it's one that can be really easily leveraged. So my point with these two setups that happened years and years and years ago is that this stock is very reliable. Like, it works really, really, really well with technical analysis, and that's why I'm so excited for what it's doing right now, for 2 reasons. The first reason is it kind of had a little bit of a mini inverted head and shoulder setup here. I wouldn't have like traded this, but it was kind of like pretty nice. And if you take this and you add that on top, you get kind of a price target right here, which is actually about the median line of this M. And that's where we get to where we are right now, is you have this M, and this M looks like absolute gold. So it kind of starts here, then it hits this peak, then it bounces down here, and then what's cool is it has a gigantic red candle and then a gigantic green candle. And this is a really, 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 really powerful setup where you have one candle that goes down a bunch, and the next candle goes up a bunch. It's a really strong reversal pattern, and it happens just a little bit above this bottom Bollinger Band. It happens right around this medium Bollinger Band, where the moving average is. So it goes back up, and it goes and it bounces into the top of the Bollinger Band, and it starts to come back down. That's what it's doing right now. And this is what the M, I mean, this is literally the exact same setup you had here, all over again with this M setup, and it looks really, 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 really good. I mean, it's just a really nice setup. And so, coming into it, what I want to see is I want to see the stock hit like right here at like 47, and like as soon as it hits there, I basically want to see like from here to here, and then you do that 2 times as a profit target. And I should probably check my math on that. You're looking at about $60 to 45. That's, give or take 15 bucks. Times 2 is 30. 45 minus 30. You got about a $15 price target aggressively. I'd say conservatively, you're looking at maybe like a $17, $22 stock right here. If you wanted to be super careful on the trade, you could maybe take it to 30. We'll look at why that matters in a moment, but it's important to see that this right here is a really, really, really nice setup that's got 2 really nice profit targets on a downside short. And so that's kind of what I want you to think about going into this trade, because when we look at the financials here, I want you to understand that we're looking at the forefront of a recession, and if this setup validates, this stock could very well decrease in value by a factor of either a 50% loss or a 75% loss, which, I think so 20 would be like, give or take like a 50% loss, and that could be really, really well leveraged with options. So with that said, let's look at the underlying financials and figure out if this company really is in trouble or not. Because if you look at the top line, like this looks like a lot of money. If we go over to the key statistics and we look at their market value, they've been growing and growing and growing and growing for years. They're a $70 billion company. Only a couple of years ago they were at 60. Like that's 10 billion in 2 years. Pretty impressive. I don't know anybody that can make 10 billion in 2 years. So I mean that's like pretty sweet. Their PE has been getting higher and higher and higher, but I mean it's like not that big a deal. But here's kind of where we start to get into some of the stuff that's not so pretty. First thing you're going to see is their operating margin is 0%, which is not good. Second thing you're going to see is their diluted earnings is like super light. Like they have good earnings. They have like some pretty solid gross profit. Like $2.4 trillion in a year is really nice gross profit. But what's not good is their quarterly earnings growth is negative 47%. I mean that's really, really not that's not good. And if we look a little bit more at what's happening under the face, we see a book value of 25 a share, which I mean it's pretty reasonable. But the growth on here is really coming into question when we look at the technicals. Now, here's something that scares me, okay? The short percent of float here, like, it doesn't even say what the short percent of float is, because if you look at the short percent of shares outstanding, which is basically always greater than the short percent of float, it's 0.16%. So that means that the short percent of float is almost zero. Like, it's within the range of like 0 to like 0.16%. And that's really, 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 really sketchy. I have like almost never seen a stock with this low short percent of float. And what this means is that almost nobody thinks this stock is going to go down. Now, I don't know if you guys remember in '08 when people were betting on the housing market, and almost nobody thought the housing market was going to go down. And if you could just think for just a minute about what happened and how that actually worked out. Oh yeah, that's right. It freaking died. And I think that's kind of what we're looking at here with Sony, is because so few, like when you have a short percent of float ratio that is so low, it doesn't even exist according to Yahoo Finance, that's when you know that investors are seriously off the hook on this stock, and that there's a really good chance it's going to go down, because usually the majority are like wrong, the minority are right. When the minority is so tiny, that's when you're going to see some of the really the biggest gains with the stock. And so to kind of validate this, I think we should really take a look at the financials, because it's important to understand what's happening with and like news too. Like, I mean, these guys, gosh, it's the numbers look great, okay? Like the currency is in Japanese yen. For those of you who don't know, we can do a quick Google search, GPY to USD, and we'll realize really quickly that the numbers we're looking at are a little bit different. 1 yen is about like a penny, so just take kind of like these numbers and just get rid of 2 zeros, and so total revenue here is in thousands, so I guess you can kind of have back like 3 zeros, and you're looking at about $8 trillion. These numbers are a little hard to read just because of the currency shifts, but really, like, everything here looks awesome, okay? Like, they make trillions of dollars. Like, that's really good, okay? If you look at their cash flow, if you look at the balance sheet, everything about this company, just, I mean, it looks phenomenal. They, on paper, are making tons and tons and tons and tons of money, just like Enron was. And, like, there's not much here to criticize. They're making investments and they're buying plants and stuff, and that's normal. That makes sense. The payout ratio for these guys is not huge. I think it's like 4. Here it is, right here. Payout ratio. You've basically got this thing at about 7%. So, like, even though it looks like they're paying out tons and tons of dividends, it's actually just a small fraction of the money that they have, which is like cool. I think we talked about this in the last video on EA, where like the company's making a ton of money, but people are still kind of selling their stock. And to validate that, we can just look up real quick insider trading. And what's interesting is, like, even though this looks like a phenomenal company on paper, the question is, like, is it really a valid company? And something that I think really scared me when I first saw this was, if you look at the chart and you go back all the way back to like the dot-com bubble, you start to see something really kind of unsettling about this company. They used to be a stock almost at $150, and in the span of like a year, they went down to like 30, and that's like really scary. That's not good. If you go over and you look at like the actual transactions, what's weird is, I think because of this company being based in like a different country, like it doesn't really, they're not reporting a ton of like actual trades, which is like kind of sketchy. Like, I've never really seen a stock not report insider trades, and this means that like no one's touching their shares, which, in an economy where it's so volatile, that's like not good. Like, if I was in the company and I saw this stock go from hit $30 to $60 in a matter of like 2 years, like, I would be probably taking some money off the table, and yet you don't see that happening, which is kind of unsettling. The last thing we can look at to really understand what's going on with their, like, besides the fact that yes, they make money, if you go to their website and you try to look up their annual report, what's kind of weird is like they don't produce an annual report, which I've never seen before. I think this is because they're like not an American company, and it's really weird. But I went and I dug deep and I found like their financial statements, and I also found this weird like presentation thing they did where they talked about like their corporate report. And I mean, it's really just a lot of like feel good stuff in here. They're just like, we're selling PlayStations, we sell video games, we're making lots of money, here's our money, it's growing, look at all this money. And like on the surface, it looks great. The question is, like, is this sustainable through a market pullback? And I don't think that it is. And we're going to look at their sectors, but they're in like a volatile sector. They're in tech, they're in entertainment, and they do a great job of what they do. But the question is, are they going to be able to hold through a pullback? And I think to answer that, you really need to look kind of at their, because they just do so many great things. But I think you really need to look at like the actual numbers. And looking at the numbers, they make tons and tons and tons and tons and tons of money. But the question is, like, is a company based out of Japan or let's see, where are these guys? Yeah, Tokyo. A company based out of Tokyo. Are they going to be well positioned to do well when the world is on panic freak out because of this virus that's killing everybody coming from China? And I think the answer is no. Something cool to note here, something to kind of note, these are American Depository shares, which means that these aren't actually like related to the underlying company. They're the American subsidiary of the underlying company. So like in terms of like how far degree of separation is between the company, you've got sort of like your company over here. Like here's Sony, okay? And Sony's got like their own little box. They're over here in Tokyo, and they're doing their own thing, okay? And then you have sort of the common stock is Sony and Tokyo. So this is like Sony stock, but this is the stock in Tokyo, right? This is the stock in China. This is stock over on their exchanges. And basically what these guys do is these bankers take the stock in Tokyo, and then they like magically transform it into this other financial product called an ADR. And this magic financial product now gets to come over to, I think they're on the NASDAQ, right? What are these guys on? The New York Stock Exchange. This magic ADR now comes over to the New York Stock Exchange, and it represents, and it's linked to Sony Corporation, right? But it's not actually Sony Corp. And like it doesn't really make that big a difference, but the important thing to notice here is that the NYSE version of Sony, so the version of Sony that like we're trading, is not actually like Sony stock. And so while Sony's paying out tons and tons and tons in dividends, what's interesting is if you look at the American version of the stock, you're still going to have a lot of the growth that comes from the underlying capital growth in Sony Corporation, all the profits that they're making, but you're going to be looking at sort of less voting power, less influence in the company, and 0.7% dividend. So important takeaway is you kind of have this separation between the investors and the actual company, and like this isn't usually something to worry about, but when you're betting on a stock going down, it's kind of a factor that I think is worth taking note of, and something that I've seen happen a lot, and it's like important because right now international markets, I mean, just frankly, if you think about it logically, we've got all this like tension in trade tension, we got all this tension in travel tension, right? Like think about airports closing down. Like I think 80% of the world right now is on like lockdown where you can't like leave the country. Like so you got travel tension because people can't even like travel places for fear of spreading this virus. And then lastly we have virus tension, right? You have virus tension. And just thinking about these things logically, right? If you think about Sony stock, there are really ADRs in general where you have like these foreign corporations, specifically like companies based out of China, which are what mostly leverage ADRs to have US listed exchange stocks. These companies are going to be in a really kind of peculiar situation where like it's not going to look great for them if you have all these tensions leading to sort of a decrease in the perceived value of the connection between the actual underlying company here and the ADR. And instead, I think what we're going to start to see is, and what we have started seeing, because I've seen tons and tons of these Chinese ADRs drop like wildfire. Like you've seen stocks like RAZFF, Razer Inc. They're like one of the biggest gaming companies on the planet in terms of like specialized peripherals. These guys have gone from I think like 20 cents before all this started to give or take like 16 cents right now. Like that is a pretty freaking massive 20% drop. You've got stocks like this. You got these ADRs that are sort of representing foreign companies, and they're decreasing in value not because of the underlying company decreasing in value, or not so much because of the underlying company decreasing in value, but instead because of the trust and the authority that's decaying away from these connections between the underlying stock and the actual asset that gets traded for in America. And that, I think, one of the big differences that's shifting away the value of this company and really harming the perception of it publicly, and what's likely leading to a lot of the share trading. And I think that's also another reason why we see extremely low short percent of float ratios, and we see extremely low insider trading, because all of that is taking place over on the Tokyo Stock Exchange on their own version of the stock. And so that's likely why a lot of these numbers aren't looking great. They're not looking great because people that have big money are trading the actual Chinese version, not the ADR. And I think that's one of the big things that could really kind of be an Achilles heel for this company. Even though it looks great, like they've got a lot of stuff that can go wrong. And when you have a lot of stuff that can go wrong and one thing snaps, all of a sudden the house of cards can fall down really quickly. And when you combine that with something like an interior Bollinger Band M setup, which is one of literally the strongest setups that exists, you have sort of a formula for a big drop. And I think that's really the big play here is yes, they make money, and yes, they're in a great industry, and yes, they're doing really well, and they're really trying to explode, and they do a great job with it. But at the end of the day, it's a question of valuation. It's not a question of corporate worth. And if the market's going to value it lower and fulfill and validate the setup, then that's where it's going to go. And I mean, you can look through these pages all day, but what's kind of important to understand is really the bigger takeaway comes from the underlying stock price and the perception of that stock price. And if the coronavirus gets worse, if international trade gets worse, if tariffs get worse, if Levi's get worse, there is a next to 0% chance that this stock does well, just because of the way it's positioned in an international market. It's just kind of how it works out. Here we see a lot of the same financials that we saw earlier on, and that we saw on finance. And I mean, I'm not gonna lie, the financials are awesome. These guys make trillions of dollars, which is really impressive. It's not something you can say about a lot of companies, but that's not gonna stop me from buying puts on Apple. It's not gonna stop me from buying puts on these guys. And it just, I'm gonna trade the setup and I'm gonna trade the stock more so than the underlying financials, because that's what really makes the market move. It's not the smiling faces on the corporate report. It's not the smiling guys that are pictured on the third page of the report. It's not the animated buddies that are in all the pages of the report. At the end of the day, what matters is the stock price, and that's what moves the stock price. Whether or not the Sonic movie does really well, or the Spider-Man movie does really well, it has no shift on the actual underlying psychology of is this a valuable company or not. And so that's I think really the trade here with Sony is if they kind of get to this price level, I'm thinking right here around the bouts of $47 or so. I think that's kind of where you want to buy puts. I'm thinking stop loss on this trade. If I would do kind of a stop loss probably at maybe 57, and that's going to give you about $10 of value that you're putting on risk at the table there. If you want to be more conservative, you could do a stop loss at 55, but I mean, I wouldn't really go much lower than that. I would want to give this trade some room to work itself out. I think the time frame on this trade is pretty basic. You're looking, you're looking at sort of an expiration of maybe August, maybe June, kind of around October. If I was super conservative, I would say this is going to take maybe 4 or 5 months, and that would kind of put us around the bouts of September. So if we go over to the options chain, I think kind of the most conservative thing we can do, because I don't want to get to lies, is to go into the October one. The October puts, assuming that we're kind of doing the trade, assuming that this trade validates, right? The trade's got to be valid. If the trade's not valid, and we're gonna say we'll use just the more conservative, give or take, $30 price target. If we go over to the options chain and we look at these Octobers, we can get 40 puts for about $2.20, and 45 puts about another maybe $3, and 50 puts are about $4. So the 50 puts will give you an inherent value of $20. You're looking at about a 5x return on that investment. The 40 puts, we'll call them I guess maybe $2.20. Those will have an inherent value of 20, so that'll give you about a 9x return on your investment. And I think that kind of might be your sweet spot here. If you look at the 35s, they're about $1, so you're looking at a 5x return there. The 45s are kind of in the middle. This is a little bit of a less well-defined price. I think these are maybe fair value $3. And so if you look at those being about $3, you're looking at an inherent value of $25. So you do 25 by 3, and we'll get about an 8x return. So just looking at it right now at the current price, I think the sweet spot really is right about $40 for the puts. You can get about a 10x, 9x return on those, assuming a value of 10 over 9 point, or over, I would say like 2.2. Oh, sorry, wait, did I do math wrong? Oh, I totally did math wrong. Okay, I'm sorry, that's a 4.5x return, my bad. Yeah, with a $30 target. Okay, so maybe not. I need to use a calculator more apparently. So I'm thinking since the stock's gonna have to go down for the entry of this trade to make sense, the stock's gonna probably need to go down about $5 or so to about $50 or $47. These options will probably have an increase in premium of about $5 or so. So maybe we'll price in like 3 in volatility because these are out of the money. You're still looking really at a nice trade here where the 55 puts are going to say, I'd say these will probably be like $8. And those will have an inherent value if it goes to 30 of 25. So 25 by 8, you're looking at about a 3x return. It's not as good. I still kind of like these 42 5s right here. You're looking at about a $3 price on these, maybe 4 or 5. I'd say like 4.2, and that's going to have an inherent value of 12.5. So I think around the 3x return is what you're looking at on a trade like this, and that's conservative. Remember, that's assuming that we only have only one of these bands goes down, and that's reasonable, and that happens. And I mean, a vast bulk of the time, a vast majority of the time, especially in volatile markets, it's not just one of these. It's usually 2 of these. And that's really where the big money play is going to be on here, because if we look at 2 of those, we have a price target of about, give or take, like, $20. I would say 17 aggressively, 15 if you're crazy. And like, just if this goes to like 20, you're looking at a return here of just massive proportions. Say we get like these 45 puts for you'll call it 350, okay? If those go to 20, you're gonna have an inherent value of $20 and $22.50, and we divide that by our initial investment of, call it 42 5s, like 3.2. That's really where the money's going to be. You're looking at about a 7x return on those, and that's really the big play with these guys, is them actually filling the entire interior Bollinger Band and setup. Max risk on this trade should be, I would say, you're looking at like stop loss of about $5, and so if you look at $5 out of the monies, you're looking at $4 versus in the monies break even at like $6. So that's about a $2 difference. So you're probably looking at that's about $2 out of $6.50. I would say kind of aggressive, conservatively over 6.5. Looking about a 30% downside, more reasonably maybe a 40% downside, and oh my God, no way! We just hit limit down. Oh, wow. That was kind of unrelated to this video, but oh wow, we just hit, yeah. So the Fed just like hit 0% rates, which is kind of crazy. Wait, so it just hit limit down? I guess we'll see what happens. Kind of unrelated to Sony stock, but also it is related to Sony stock, because if the market starts crashing, there's no doubt the internationals are going to follow right alongside with it, and this is a great trade to leverage that with conservatively a 3x return, aggressively a 9x return, and I think with more volatility, the time value on these options will actually explode a bunch too. If you want to you can totally take some of these shorter term contracts that have a little more risk. You look at these July 40s, they're going to be like way cheaper. Holy crap, those are way cheaper. So instead of paying $2, apparently you can pay like $1, which is kind of crazy. That should double your return, make it about a 14x return if it does it in a couple of months instead. So I might put maybe like 20% of the position in July if you take this one. I think it's a really nice setup though, and assuming that this thing validates, like the moment it goes under like 50, maybe 47, I'm gonna be swiping these up pretty hard, because I think pretty conservatively, just doing some quick finger math, that this is basically like a 22.50 stock. within the next year or so, hopefully within the next 5 months. And that's really the big takeaway and the big call and the big strategy on these guys is, yes, they're awesome, and they're going to be super awesome when they go down a bunch and they explode on these puts, which is really cool, and really just a great stock to pick. You guys have had like so many amazing setups in the past couple of years. They're one that I'm going to have sort of on my more active watch list more often, just because they are a really nice stock to trade. So that's kind of the big takeaway here. It's a partial M setup, like it's not completely completed yet. It's got to get completed, like it needs to complete first, and as soon as it completes, kind of right around here, that's really where you're going to have your entry point. And honestly, like if it completes and you're all the way down here at 45, I think you could pretty conservatively set a stop loss at somewhere around like 50, 52 and still be safe, because these M setups are pretty cut and dry. Either it confirms the M setup and it starts to go down and it goes down, and then you get in and it goes down, or it doesn't. Okay, it either does or it doesn't, and pretty quickly with these, they're pretty cut and dry. And just based off of the way the market is right now, I think it's pretty clear that this is a pretty damn good chance it goes straight down. And these puts are looking pretty nice on it. So that's kind of the big takeaway here with Sony. I love the company, I love what they do, and hopefully they will kind of validate this setup. And assuming they do validate this setup, I'm gonna love trading this stock too. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learn a lot about them. Now, what's cool is if you have an investment that you think could look really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is you really comment down below with the ticker of the stock. I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out, or when these new stocks do come out, you'll be able to YouTube will know to send you the stuff, and if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now, or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very high-level seminar I gave. The students literally go through and in their first month make 5, 6 figures, and I can't guarantee anything, but I know for a fact that this stuff works, and it's gold. What I want to do is I want to give you this course I used to sell for tons. I want to give it to you completely for free, so you can learn the top 35 secrets that you can use within the next week to really crush your portfolio, really double it, and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com, and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the master class. Thanks. Bye.